You are listening to the Retirement Lifestyle Advocates radio program. I'm your host, Dennis Tubbergen. Thanks for tuning in today. Joining me in segments 2 and 3 of today's program is returning guest Dr. Charles Nenner. Dr. Nenner is a highly regarded cycles analyst, and I'm going to chat with Dr. Nenner about his forecast moving ahead for the U.S. economy, for inflation, for interest rates, as well as stocks and bonds and gold. I had a very in-depth conversation with Dr. Nenner. I am going to share it with you in its entirety today in segments 2 and 3, so you'll want to stay tuned for that. If you have not yet created your free login to access all the free resources at retirementlifestyleadvocates.com, I'd like to invite you to do so. At the website, retirementlifestyleadvocates.com, you can access my weekly headline roundup newscast. You can also access my weekly newsletter titled Portfolio Watch, and you'll also get the podcast version of this program. A login is required, but it is free. Again, go to retirementlifestyleadvocates.com and take advantage of all those resources. Thank you to all of you that went out and provided some support and purchased my latest book titled Winning Strategies, the definitive guide to tax planning, legacy planning, and wealth preservation in the current economy. Upon its release, Winning Strategies was actually classified by Amazon as the hottest new release in 4 categories, and it was a #1 bestseller in 2 categories. So thank you to all of you that supported the book effort. I'm very, very appreciative. For this month, I'm offering a copy of my book, Retirement Roadmap. Retirement Roadmap contains some tax planning strategies that came about after the Secure Act was passed. I'd love to send you a copy of that book absolutely free. All you need to do to get it is go to the website, requestyourreport.com. The website, again, is requestyourreport.com. Just let me know where to mail the book, and I'll be very glad to do so. You know, the stock market is continuing to go up. We have gold also up about 30% year to date. And those two statistics, with the market up year to date and gold up year to date, those two events, those two outcomes often do not happen. Now, I want to share with you one of my favorite stock valuation tools or stock valuation metrics. It's not often discussed, but it's something called the Dow to gold ratio. It is simply this. It is simply the value of the Dow Jones Industrial Average, which is a little over 42,000, divided by the price of gold per ounce. Well, when you take the Dow and divide by the price of gold per ounce, you get a factor of 15.45 roughly as I am recording this week's program. Now, if you go back to the tech stock bubble peak in 2000, the Dow to gold ratio was about 43. In other words, on a ratio basis, it took about 43 ounces of gold to buy the Dow, and now it takes between 15 and 16. If you go to market bottoms in the past, you find that this Dow to gold ratio has often been 2 or even 1. So, for example, after the bear market that occurred in the 70s, we had a Dow to gold ratio of 1. The Dow was 850. Gold was about $850 an ounce. 850 divided by 850 gives you a ratio of 1. Now, I fully expect that we are going to see that ratio at some future point get back to 1 or 2. There's more than 100 years of track record that tells us that we will likely see that. So what does that mean? It means that ultimately I am expecting that stocks will likely drop, and I'm expecting that gold will likely continue to go up. Now, I don't expect that markets will go straight up or straight down. I can't tell you exactly when we're going to get there, but I can tell you that by many measures, stocks at this point are overvalued. So, for example, let's look at another stock valuation indicator, something called the Buffett indicator. Now, the Buffett indicator was actually named after the famous investor Warren Buffett when he stated in an interview that it was one of his favorite stock valuation measures. Now, the Buffett indicator takes total market capitalization. Now, if you're not familiar with the term market capitalization, that is just the total value of all stocks added together. So total market capitalization, the total value of all stocks added together, becomes the numerator of the fraction. And gross domestic product or economic output is the denominator of the fraction. At the present time, stocks are about 195% of the economy. Can we say that stock valuations are about twice economic output? Now, historically speaking, less than 100% is considered to be normal. In fact, stocks have been more overvalued than they are today by just a little bit in December of 2021. And in 2022, we saw a pretty significant stock decline, about 18%. Now, the Fed recently has cut interest rates. On the 18th of September, the Federal Reserve cut the Fed funds rate by 0.5%. Of course, the question is, will this rate cut continue to fuel the stock market rally as it has in the past? Well, we'll have to wait and see. But even if it does, keep in mind, unless we have a significant increase in economic output, the Buffett indicator will still become more overvalued. So we don't know what is going to happen, but early indications are that interest rates are still going up. Now, why is that? Well, if you look at the 30-year U.S. Treasury bond, on September 17, the day before the Fed cut interest rates, the yield was 3.96%. Presently, that yield is well over 4%. So after the Fed cut interest rates, the Fed funds rate, we saw interest rates on the 30-year government bond go up. And typically, mortgage rates tend to track U.S. Treasuries. So we've seen mortgage rates go up as well. Now, why is that? Well, if you're loaning the U.S. government money, you are going to demand to be paid an interest rate that is commensurate with or in line with the investment risk that you're taking. The U.S. government ran a $2 trillion deficit last year. And the U.S. government, according to Matthew Piepenburg, who wrote a piece for Gold Switzerland recently, the U.S. government will need to refinance about $16 trillion in debt over the next 3 years. So that is a pretty gloomy fiscal picture, and certainly someone thinking about buying a U.S. government bond is going to probably require that they be paid a higher interest rate because the U.S. government is not becoming a better credit risk by the day. Now, Moody's, one of the major rating agencies, recently threatened the AAA credit rating of the U.S. government. Now, on the Moody's scale, AAA is the highest possible credit rating. It is the best credit rating that you can get. Well, Moody's, in a statement, gave U.S. debt a negative outlook. And they stated this: the next U.S. administration will have to grapple with widening budget deficits. That's kind of stating the obvious. The rating agency suggested that the debt dynamics will be increasingly unsustainable and inconsistent with the top AAA credit rating if no policy actions are taken to course correct. Now, as I've stated here on the program previously, it's going to be difficult to address this problem, and it's going to likely require severe spending cuts since 3 of every 4 personal income tax dollars now collected go to pay interest on the debt. In fact, the U.S. government is now borrowing money to pay interest on money that has been borrowed previously. Now, Moody's actually here may be a little bit late to the dance. Standard & Poor's stripped the U.S. government of the top safety rating back in 2011, and the rating agency Fitch took the top rating away from the U.S. government last year. So what does this mean for you? It means at some future point, we are likely going to see interest rates continue to go up, and in my view, likely go up a lot more. And I'll talk to Dr. Nenner about this in the next segment of the program. If that happens, a traditional bond mutual fund like you might own in your IRA or 401k will likely lose money. And stock mutual funds, if stocks correct here, given that they are, again, very overvalued by just about any metric, as I stated earlier in this segment, when stocks correct, stock mutual funds will decline. So we're entering a period of time that I believe will be a difficult investing environment. And that's one of the reasons I'm offering the free resource Retirement Roadmap on today's program. When you go to requestyourreport.com, I'll not only send you the Retirement Roadmap book, which contains some tax planning ideas for retirement, also some investing ideas for retirement. I will also send you a copy of a couple of my recent newsletters. So go to requestyourreport.com. I'll send you all that information for free, including the Retirement Roadmap book that we are just now making available for free. I'll be back after these words with my special guest, Dr. Charles Nenner. Welcome back to RLA Radio. I am your host, Dennis Tubbergen. Joining me once again on today's program is returning guest, Dr. Charles Nenner. Dr. Nenner is a brilliant technical analyst. He was last on the program about 6 months ago. I always look forward to having him on the program, and you can learn more about his work at charlesnenner.com, and you can even get a free trial, no credit card needed at charlesnenner.com. So, Dr. Nenner, welcome back to the program.
Hi, it's great to be back.
So for our listeners, maybe, Charles, that are not familiar with your work, can you explain a little bit about your background and the road that took you to where you are now?
Well, I'm originally a medical doctor trained, and while I was doing research for the psychiatry department, we were looking into if in different parts of the world people become psychotic at the same time, which we found they did. And then we also found that they, every so many years, every so many months, every so many weeks, they also become more psychotic. Now, we knew, for instance, that there are a lot of pre-birth if it's full moon. We still don't know why, but you better have your stuff ready in the hospital. So then I was on vacation and I saw a program at Wall Street, in this case CNBC, and I heard it was going up, was going down. I said, well, let me take a look at if they're the same cycles and the same systems that apply on what we did, which they did. And then from that on, I made a whole career that ended with being managing director in Goldman Sachs. I did the timing for all the only investments for Goldman Sachs and the hedge funds. And then after the crisis in 2007-8, when Obama said, we think it's too dangerous what you guys are doing, the position is too big, then I left and I started my own firm. And what the firm does is it looks at the different assets like S&P, NASDAQ, European stocks, gold, silver, euro currency, VIX, the grains, you can, everything. And we do it based on the what I call neural networks that I built 40 years ago, what now you call it AI, that will tell you exactly what's going to happen, which day it's going to happen. So if you want to buy a certain asset, we know which day and which week it bottoms and at what level it bottoms, how many days it goes up, and what the upside target is. So we have been doing that with great success year after year. And
Dr. Nenner,
yeah.
No, I'm sorry.
No, keeping especially people out of trouble. Like now, I think we're ready for big trouble in the stock market. So we had a target on the S&P of 57.75. I see it's now trading 57.77, and we're almost totally out of stocks.
So what's interesting to me, Dr. Nenner, is you post your cycles recommendations in different markets as to what your returns are in real time on your website, which is charlesnenner.com, and it's quite impressive, I have to say. And I have been privy to your research for a very long time, and it's something that I look at regularly. So let me ask you maybe just some big picture questions, and then we'll get into some specific markets. But if we look, for example, at what your cycles are telling you about interest rates, we recently had the Federal Reserve cut interest rates. At the same time, we saw mortgage rates go higher. How do you reconcile that, and what's your research telling you about where interest rates go from here?
Well, first of all, sorry, we published the long-term cycle. We have a cycle of long-term interest rates of about a couple of 100 years, and we just started in 2010 around that, starting for the next 30 years to have high interest rates. So this is just the blip. We're going to have much higher interest rates. We're going to have much higher inflation. What I wrote is, and I don't want people to missleep, but I showed them that the cycles, and those are yearly cycles, those are long-term cycles that lined up before the crash of 1929 are lining up next year. So we're in for a very, very big, dangerous situation. And so we were handling this and telling people where to be in, where not to be in. We told them to be very defensive on stocks, which we are now. We also told them to be defensive on bonds, which is interesting because I know what the Fed did, but still the bonds are coming down. And we're dealing with gold and silver, and we're trying for most subscribers that I have for years to survive the next couple of years.
So, Dr. Nenner, is it your take that the Fed has kind of lost control of the interest rate market?
No, I don't think so. Just the short-term rates are not the same as the long-term rates. And what always bothers me is that they make speeches like, we go from month to month. We look at the data. And don't they have long-term cycles like I have? I mean, an economy is not moving from month to month. It's like a cruise ship that goes a little bit to the left, to the right, and it moves very slowly. So I don't know what they're doing over there. But a stock market has never been saved by the Fed lowering interest rates. So I don't know why everybody's focusing on these interest rates all the time. I guess it's also the media that make people misunderstand how financial markets work, but that's not how it works. So that's why we always say, take a look. We have a 30-day free subscription. You don't have to like it, but at least you see how the insiders look at markets and how they make their money, not by listening to the news, because the news is not important.
Well, and again, the website to check that out, I'll give it to the listeners again, is charlesnenner.com. Dr. Nenner, you stated that we're going to have much higher inflation moving ahead. I found it interesting that, the Fed kind of took a victory lap saying that, inflation is now under control, when any of us that go to the grocery store or buy anything know that is not the case. How much of this interest rate cut would you say was political, and how much of it has to do with the fact that the U.S. government has to refinance about $16 trillion in debt over the next 3 years?
Well, the last thing indeed is a big, big problem. That this country, I mean, it's your country, I'm from the Netherlands, is really in trouble. And this is how empires go under, because they have these big deficits and nothing functions anymore. And this is an example of the destruction of the United States. What they don't understand is that in Europe, if you have an auction, then 90% or 95% of the local people buy your bonds. And here it's, I don't know, the Chinese, maybe 60%. So if the Chinese really had enough, they're going to sell it. They're going to throw it in the market. Interest rates will usually rise up, and people will follow and sell the bonds. And then you have a big, big crisis in the bond market, which actually we have already, because I remember a couple of years ago when the 10 years was below 1%, I think the the 30-year bonds were trading around 190. We totally went out, and there had been a bull market for 40 years, so people couldn't believe that something like that would happen. I says, well, if you think that it's never going to be inflation and interest rates never go up, you stay in there in the bond market. But so much money has been lost in the bond market, more than in the stock market, because people who seem to be conservative are more in bonds than in stocks. So what you say is totally correct. Fundamentally, the thing is going to break down. But like I said, I don't deal with that anymore. I only deal with what's going to happen and when it's going to happen, and leave it to the other people to make an interpretation why they think it happened.
Well, I'm chatting today with Dr. Charles Nenner. The website, again, is charlesnenner.com. Dr. Nenner, as you were talking earlier, you drew a parallel to, I believe, some point next year in 1929. That is a pretty ominous statement to make. Are you forecasting that stocks are going to do what they did starting in 1929, which I believe is about a 90% decline?
In the end, the problem is it's a yearly cycle, so it's going to happen next year. And when we move into the year, I can look at quarterly, monthly cycles, and then I can pinpoint more exactly when it's going to happen. But it's going to happen next year. And I've been saying this for a long, long time. The longer the cycles, the less they can be influenced by anything. So these are yearly cycles, and that's what's going to happen. Now, we have a feeling maybe that things are not totally going well in financial markets, but we have the same situation as in 1928 when it says, well, we're on a high level of stocks and we're going to be there for the rest of our lives, and stocks are never going to sell off anymore. And every time that my insiders are selling and it goes down a little bit, then the retail people, the small investor picks it up and it brings it back up, and then the big guys sell it again, and the small guy picks it up, and in the end, the same thing's going to happen. The insiders are making money when it goes down, and the small investor is going to lose his shirt.
So, Dr. Nenner, do you have a downside target for the Dow or for the S&P 500, whichever index you'd prefer to reference?
Well, we said with the first downside target is 3,800 on the S&P. That's the first one. That's not so serious, but that's the first one. Then you could see a bounce from there before we continue down. That's what the system comes up with. So that's still a big problem.
That's a big decline. Yeah, that's down 30+% from here.
Yeah.
So, Dr. Nenner, we've got about a minute left in this segment. As far as interest rates go, looking at U.S. Treasuries, how high can interest rates go?
Well, in the end, if you take the long-term cycle, they will get back to where they were in the 80s. We're talking 40, 15, 16%.
Wow. Okay. Well, my guest today is Dr. Charles Nenner. His website is charlesnenner.com. He's offering the listeners today a free trial to his work. No credit card needed. More information at charlesnenner.com. I'll continue my conversation with Dr. Nenner when RLA Radio returns. Stay with us. I'm Dennis Tubbergen. You are listening to RLA Radio. My guest on today's program is Dr. Charles Nenner. Dr. Nenner is a brilliant technical analyst. If you missed what we talked about here in the first segment, Dr. Nenner has been using AI before AI was even a word, before even fashionable. So you can learn more about his work at charlesnenner.com. Dr. Nenner, let's talk a bit. You gave us a rather ominous forecast for stocks, that there's a lot of downside here. And maybe just to reiterate, you think that we could see some downside in the market here starting very soon. Is that the case?
Yes, very soon, maybe even next week. There are also some objective indicators that are not my indicators, and one is called the Buffett indicator. Maybe somebody knows about it. Buffett made his own indicator years ago where he takes the total capitalization of the market against the GDP. And it is super, super, super high. So that is a big warning sign, especially if we get into a recession that I think started already. The other thing is what people hear if they go to a broker, they should have been stock, and the broker will say, well, on the average, stocks go up 7-8% a year. Well, how does he get to that? Because he starts in 1900, and then he draws a line with an angle of 7-8%. And then he says, okay, look, it's 7-8%. What he doesn't tell you is that we're about 80% above that line. So in order to get back to the average, you have to go down 80% below the line. And nobody seems to talk about that. So it's not that every year we go up 7-8%, because we went totally to the roof on that average. So these are very not my indicators that show that things are totally out of hand. And then if you look at the PEs and you look at the weakness is going to come in the economy, then the profits are going down. I'm not even talking about Kamala Harris, who has all these ideas to take away profits from companies and make it impossible to have a capitalist society. My European clients are very worried about it. The American clients says, well, he says it, but she doesn't mean it. Well, in Europe, we learned the hard way that if people say something, they usually mean it. So they're selling and they're selling. So there are enough reasons, and it blows my mind why, in the United States, nobody seems to feel any fear.
Dr. Nenner, often when we see stocks decline, we see commodities move inversely or in opposite directions to stocks. What are you seeing first as far as, maybe let's start with agricultural commodities? If you look at corn, you look at soybeans, those prices have been in a downtrend. What are you seeing there? What are your cycles telling you?
Yeah, we have in a downtrend. I'm playing a downtrend, but depends what you look at. But let's say the average wheat, corn, beans, the longer term cycles bottom in 4 or 5 weeks, and then we should start in the bull market. The same is true for the what we follow is the Goldman Sachs commodity index that just started to move up, and everybody seems to be on the wrong side. I think people are going to be surprised that the inflation is going to pick up again, and maybe that's one reason why, although the Fed lower rates, that the bonds are selling off every day.
So, but before we shift gears, maybe and talk some metals and mining shares and maybe some cryptocurrencies, you mentioned in the last segment that you could see interest rates getting back to a level that we saw, in the early 80s, 14, 15, 16%, I believe you said. Do you see inflation as, on a real basis, getting back to that same level also?
I think so, but I just want to make a point that also deflation can bring interest rates up if nobody wants to loan any money anymore to anybody. And if you have, let's say, a portfolio and the stocks are going to crash, so the next thing that you have to sell if you need money are the bonds. And usually the thing after that is the real estate. So if you have to sell, you have to sell. And it doesn't really matter what the inflation picture is. But in this case, it's going to be hyperinflation.
Hyperinflation. So how do you define hyperinflation, Dr. Nenner? What's your definition of hyperinflation?
Well, I would say normal high inflation is still around 10-15%, but hyper is going above those levels. I mean, you should know that in Europe, when we were at the top of inflation, what was it, a year and a half ago? Where I come from in the Netherlands, the inflation was already 19%. So wow. If we help now because the crude oil is not really in the bull market right now. It's coming, and natural gas will be in a bull market, and the grains will be in a bull market. And people will be surprised what's going to happen.
Well, I'm chatting today with Dr. Charles Nenner. If you go to charlesnenner.com, you can take advantage of a free trial that Dr. Nenner is offering all the listeners today, and no credit card needed to take advantage of that free trial. So I'd encourage you to check that out. Again, the website, charlesnenner.com. So, Dr. Nenner, was interesting because I believe the same day the Fed cut the Fed funds rate, cut interest rates by 50 basis points, we saw the spot price of gold reach an all-time high, eclipsing the $2,600 mark per ounce. What are you seeing for gold moving ahead?
Well, it just went up because it was already in a bull market since I think Well, with the bull market long from 1400, now we're almost 2700. Because if interest rates, short-term interest rates are lower, then it's cheaper to buy gold. What we see over here is, well, depends on what period you look. We can see some weakness for the next week, 2 weeks, but we're just going to continue to be long for another year and a half.
So you're seeing gold going higher. Do you have an upside price target for gold in your research?
No, not right now, because it reached the upside price target and I just didn't have time to look for the next one. We just following so many markets, so we also get special requests. For instance, a hedge fund says, I like to buy IBM, but I don't know exactly when to buy IBM, because if they buy IBM and they're right, it could take half a year until the markets finds out they're right. So they're sitting on this IBM for half a year, not making any money. So then we build a special case. We tell them, which period to buy IBM and at what level to buy IBM. So we're a bit short-handed, so we do what comes first. But I'm going to publish it probably in a couple of weeks.
Okay, great. Fair enough. So let's talk a little bit about real estate. Do you see real estate declining along with stocks? What are your cycles telling you?
Yeah, definitely. There's a very clear cycle in real estate, and it's stopping. And it's now especially that if interest rates will go a little bit lower, the mortgages will be a little bit lower, then more people that cannot afford will buy real estate, buy a home, and that are the weak people, and the whole thing will be coming tumbling down. There's no question about that. No. What we do is, and we did it in 2007-8, there are home builders like Toll Brothers, Olenar, and they have long-term leaps. Leaps are like options, but they can be out a year, 2 years. So you can take the value of your house when we top and then buy some leaps. And if the thing comes down, you lose the money in your house, but you make it back on being short the housing market. So that's one thing we time for the big investors also.
So when you look at real estate, do you see the real estate market correcting like it did in 2007-8, that period of time you just referenced?
Yeah, probably worse than that.
Okay, so you're talking 40, 50%.
Yeah, that was just a temporary scare. And, with all the interest rates help and whatever, it was fixed again by the Federal Reserve, but things basically are not healthy.
So we have listeners that are big fans of cryptocurrency, primarily Bitcoin, but Ethereum as well. You mentioned that gold is in a bull market. It has reached your initial upside price target. You expect it to go higher, I think, for the next 18 months or so. What's your opinion on crypto?
Well, the crypto is the most easy market because crypto is not being bothered by any news item that comes out. So it's all emotional, and the cycles are built on emotion. So we do the crypto 4 times a week, and we tell them exactly what the price targets are, and if the cycle is up and if the cycle is down. And if you look at a track record, I think you'll make like 250 or 300% a year, which might not look impressive if you're in a market and it only goes up, but it doesn't only always goes up, it also goes down when we make the money. So we do the Ethereum, and we do the crypto, and we do the ETFs, and it's a very easy market. So now it looks okay until later December. Not going a lot higher. We might test the highs, but the cycle looks okay till the middle of December.
So, Dr. Nenner, we have a lot of listeners to the program that are aspiring to a comfortable, stress-free retirement. They have the option in their retirement plans with their employers to largely invest in stocks or bonds or, like retirement target funds, target 30, 20, 30 funds, whatever you're going to retire. Those are primarily stocks and bonds as well. You haven't really given those people a lot of good news on today's interviews. So what advice might you have for them?
The advice I might give, and I tell that to some newcomers, is that if you buy a 2-year note, I think now it came down, you get maybe 4.5%. Watch our research and then work with the 4.5% to make money on the side, and then at least you break even. If you're out of stocks and bonds, then you're safe.
All right. Well, we're going to have to leave it there. My guest today has been Dr. Charles Nenner. The website is charlesnenner.com. Nenner is spelled Nenner, charlesnenner.com. He has a free trial to his work that you can sign up for. No credit card needed. I encourage you to do that. Dr. Nenner, always a pleasure to catch up with you. Thank you for joining us today, and love to have you back down the road again.
Okay. You're welcome. Bye-bye.
We will return after these words. You are listening to RLA Radio. I'm your host, Dennis Tubbergen. Glad you're listening in today, and thanks again to my special guest, Dr. Charles Nenner, for joining us on today's program. If you've not yet done so, I am offering for the first time my best-selling book, Retirement Roadmap, absolutely free. You can get a copy of Retirement Roadmap by visiting the website requestyourreport.com and let me know where to mail it. I'll be very glad to do that. Retirement Roadmap contains tax planning opportunities for you after the Secure Act, things that you probably want to consider, as well as some investing strategies for today's environment. Again, the website, requestyourreport.com, to get a free copy of the Retirement Roadmap book. You know, when we start talking about taxes and tax saving strategies, it's my view that it's going to be more important for you to give this some of your attention than it ever has been at any time in the past. There have been some changes proposed to the tax code, some of which, in my opinion, are absolutely crazy, including the idea that tax would be imposed on unrealized capital gains. Now, those who are in favor of this rather radical change to the tax code point out that when this was proposed recently, it was only going to apply to taxpayers with wealth above $100 million. Well, I'm a bit of a history buff, and when I heard that, it reminded me of how the income tax was sold to the American people. See, the income tax became permanent in 1913 when the 16th Amendment to the U.S. Constitution was ratified. As a side note, that's also the same year the Federal Reserve was founded. So, again, in my opinion, not a great year in U.S. history. Well, when the income tax was originally sold to the American people, it was going to be only for those who were considered to be wealthy. Now, the trouble is, over time, the definition of wealthy changes, and new taxes that are initially peddled as being only for the wealthy often end up impacting many more taxpayers. And this is exactly what happened with the income tax. The original income tax law exempted income of $3,000 annually if you were a single taxpayer, and it exempted $4,000 per year in income if you were married. Now, there are lots of adjustments out there for inflation to put those numbers into today's dollars. Many of those inflation calculators use the Consumer Price Index, which, if you've been a long-time listener to the program, you know it has its flaws. So I'm going to do something very simple. I am going to see what that exemption was then and now compared to the price of gold. So in 1913, 1 ounce of gold in US dollars was $20. If you were married and you had a $4,000 exemption, if we took $4,000 and divided by the $20 ounce of gold, we'd get 200 ounces of gold. Today, 200 ounces of gold would be worth a little bit more than $500,000. So roughly speaking, the income tax originally exempted incomes under $500,000 for married couples adjusted for today's dollars. Now, here were the numbers, and this comes right from the IRS's website. In 1913, there were 328,000 income tax returns filed out of a population of 92.3 million people. So only 0.36% of the American public paid income taxes for the first year the income tax became law, about a third of 1%. So that really means the 16th Amendment to the U.S. Constitution was ratified, and this new, at the time, rather radical tax was put in place. And the population agreed to it because 99.64% of the population was not affected. Now, it's about that same percentage today that would be affected by a tax targeting those with $100 million net worth. It's less than 0.5%. Now, predictably, you know how this story ends. Over time, the income tax impacted a greater percentage of American households. By 1941, instead of 300,000 tax returns filed, there were 26 million tax returns filed out of 132 million people in the population. So a tax that, when implemented, required less than 0.5% of the population to pay it, demanded 20% of the population participate within just a few decades. That is the nature of taxes. They don't diminish as time passes. When you study history, they almost always increase. Now, I could give you another example as it relates to Social Security taxes. Many of you who are collecting Social Security know you are paying taxes on your Social Security benefits. Social Security taxes first became taxable back in 1983. The income thresholds at which Social Security was taxed in 1983 was $25,000 for a single taxpayer and $32,000 for a married couple filing a joint tax return. Those thresholds have not changed since 1983. So here we are 41 years later. And while very few people paid taxes on their Social Security when this started, now many, many people, just about all of the people that I talk to at our classes, end up paying taxes on their Social Security. There are many other examples. Why do I bring this up? I bring this up because the book Retirement Roadmap gives you some tax planning strategies for you to consider now. You have an opportunity under current tax law potentially to implement a couple of tax saving strategies that will sunset in 2026. So if you're thinking about retiring, not only do you want to have a good income model, not only do you want to have a good allocation model that gives you a high probability of meeting all your goals in today's rather crazy economy, it would also be very smart of you to do some tax planning while you still can. It is possible for some people, as they're approaching retirement, to arrange and structure their finances in such a way that they can even have a tax-free retirement. Now, that's not everybody, but certainly it's an outcome that some people can achieve. So as I close today, let me remind you, you can get the Retirement Roadmap book and other bonus information by visiting the website requestyourreport.com. The website, again, is requestyourreport.com. Just visit the website, let me know where to mail the information and the book, and I will be very glad to do so. Also, if you've not yet done so, go to Retirement Lifestyle Advocates and create a free login and access all of our resources there. That's at retirementlifestyleadvocates.com. That's all the time I have for this week. I'll be back again next week.